In today's episode, I'll talk about three very interesting stories. In the first story, I'll talk about how Zudio's parent company Trent is now entering the lab-grown jewelry segment. In the second story, I'll talk about how gold has suddenly become a very hot commodity. And in the third one, I'll talk about India's rising forex reserves and what it really means for you and me as investors. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest stories of the market in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 9th of October. Trent, which is a part of the Tata Group and is known for popular retail brands like Westside and Zudio, has recently taken a very interesting step into the jewelry market. They have launched their own lab-grown brand called POM. Now, initially, POM will be available in a few Westside stores and will offer a variety of jewelry pieces like earrings, rings, necklaces, and bracelets. But if you've been following Trent's progress or have been buying either from Zudio or Westside, you will probably know that they have been expanding very aggressively, especially with Zudio. So their latest venture into the lab-grown diamonds industry feels like another smart move, especially given the momentum of this lab-grown diamond trend. By the way, in case you're new to the concept of lab-grown diamonds, they're artificially engineered diamonds which look and feel almost exactly like natural diamonds but cost about 1/10. So while a 1 carat natural diamond will cost you upwards of 2.5 lakh rupees, the same configuration in a lab-grown diamond will cost you around 25 to 30,000 rupees only. Now back to Trent entering the lab-grown diamond space, let me explain why this move is so interesting. See, the first and the most obvious thing is that this positions Trent to capitalize on a growing segment of consumers, which is those people who want diamonds but aren't quite willing to pay the high prices for natural ones. But the more interesting part here is that it raises questions about POM's impact on Tanishq, which is India's largest jewelry brand and also a part of Tata Group. Tanishq has been publicly very careful about entering the lab-grown diamond space. Their CEO Ajoy Chawla recently said that while some consumers are definitely curious about lab-grown diamonds, most people still prefer natural ones. So if you think about it, while one Tata Group thinks that a market for lab-grown diamond does not even exist, the other one is building a business around it. Also, Tanishq is not alone in its hesitation to move towards lab-grown diamonds. Other major players in the jewelry space like Kalyan Jewellers and Malabar Gold have also been very slow and cautious before deciding to accept lab-grown diamonds. But some companies like Senco Gold are starting to test the waters with pilot programs. They're expecting lab-grown diamonds to form a small but still a growing part of their business in the future. But all that said and done, what makes Trent's approach stand out is its aggressive pricing and growth mindset. By offering lab-grown diamonds at prices 70 to 85% lower than natural diamonds of similar quality, the assumption is that Trent will be able to disrupt the market in a very similar way as how they did with Zudio in fashion retail. And given how India traditionally loves its diamonds, it'll be very interesting to see which Tata Group's thesis gets proven right over time. Will POM do well with lab-grown diamonds, or will Tanishq's opinion on the market for lab-grown diamonds not being big enough stand tall? Only time will tell us, but it'll surely be a very interesting thing to keep an eye on. In the next story, I'll discuss how gold has performed well and has become one of the hottest assets this year. For some quick context before that, gold is up 18% this year, which means it is doing better than the Nifty, which itself has risen by 15%. And just yesterday, gold hit an all-time high in India at 7,870 rupees per gram. So the question here is, why the sudden surge and what is really happening? See, there are a few key reasons behind it, and I will try to explain it in simple terms for all of you. First, let me talk about the interest rates in the US. See, the US Federal Reserve has been hinting at more rate cuts after lowering them by 50 basis points in just September last month. Why does this matter for gold, you might ask? See, it is all about how gold compares to other investment options. Unlike bonds or savings accounts, gold does not quite pay interest. So when interest rates are high, holding gold can feel like a missed opportunity because you're not quite earning anything on it, right? But when rates come down, that gap closes down. I'll explain this with a simple example. See, suppose bond yields suddenly drop from 5% to 2%. In such a scenario, owning gold suddenly feels like a much better deal because you were never dependent on interest yields at all. And that is exactly what is happening right now. Lower rates are making gold more and more attractive to investors. But interest rates are not the only factor that is causing gold to surge. Central banks have also been buying a lot of gold recently, which has been another huge factor in keeping gold prices high. These banks are trying to reduce their reliance on the US dollar, and gold is a very important part of their strategy. To give you some sense, currently central banks make up about 1/4 of the global gold demand, and countries like India and China are leading the way here. So the steady demand from central banks is putting a solid floor under gold prices, which is making investors even more confident in the asset. The third reason for the rise of gold prices is increased consumer demand, especially in India and China. See, in India, the government recently cut import duties on gold, which led to a surge in buying, especially in the jewelry market. In China, more investors are putting money into gold, whether through local ETFs or just buying it outright. And let's not forget, gold holds deep cultural significance in both India as well as China. It is traditionally seen as a safe store of wealth, so when people are feeling uncertain about the future, they do tend to look at gold to protect their savings. The fourth reason is exactly a continuation of that. See, currently there is great geopolitical stress around the world. There's war in Ukraine, unrest in Middle East, and a lot more that's going on. And all of this is making the world feel pretty unpredictable at this point in time. And whenever things get wobbly, gold ends up shining. It is seen as a safe asset where people park their money when other investments start to look too risky. Now, those were basically all the reasons why gold is rising. Let me now explain how investors are reacting to this change. See, gold ETFs have seen consistent inflows over the last 4 months after a period of outflows earlier this year. Investors, particularly in the West, are starting to bring gold back into their portfolios as the economic outlook becomes more and more uncertain. With more rate cuts expected, gold is becoming a more attractive option once again. So the question here as investors is, where could gold really go from here? See, right now, gold is trading at around $2,650 an ounce. Goldman Sachs predicts that gold could hit 2,700 US dollars by early next year, assuming the Fed keeps cutting interest rates and geopolitical risks do not ease up. UBS is also saying something very similar. They're expecting 2,700 US dollars by mid 2025, especially if central banks keep buying and the Fed continues to ease. But looking ahead, there are a few things that we as investors need to keep an eye on. First, what the Fed really does with interest rates over time. Second, how much gold central banks continue to buy. And third, if there are any changes in the geopolitical landscape. See, if the Fed cuts interest rates more aggressively or if economic conditions worsen, gold could definitely keep climbing. But on the other hand, if Fed holds off on cuts or if tensions start to ease down, it could definitely slow down gold's momentum. Moving on to the third and the final story of the day, let's talk about how India recently crossed a very significant milestone. Our foreign exchange reserves have surpassed 700 billion US dollars. Now, this achievement places India amongst only 4 other countries worldwide to reach this mark. Now, this number has grown from covering just 4.8 weeks worth of imports in the 1990s to now more than enough to finance our import bills for 9 months straight. Now, this is a big deal for sure, but it also raises a few interesting questions. How did we get here? Where is all this forex coming from? And why are we holding on to so much of it right now? Let me try and answer some of these questions for you today. But first of all, let me explain what foreign exchange reserves or forex reserves really are. See, essentially, these are assets held by a country's central bank, like the Reserve Bank of India, in foreign currencies such as the US dollar, euro, pound, and yen. As of September 27, 2024, 87% of India's reserves are in foreign currency assets like bonds and treasury bills, 9% are in gold, and the rest are in special drawing rights and positions with the IMF. Now you might wonder, what really makes these reserves go up or down? See, forex reserves change based on the flow of money into and out of the country. If more foreign currency flows into India than the amount that is leaving, our reserves tend to go up. But if more money is leaving than what is coming in, our reserves fall. So what drives this inflow or outflow? See, trade is an obvious factor. Imports reduce our reserves while exports boost them. There is also income from abroad such as dividends, interest, and remittances sent home by Indians who are living overseas. All of these transactions fall under what is called the current account balance. For India, this account balance has usually been negative because we tend to import more than how much we export. Even though we receive income from abroad and remittances, the scale of our imports pretty much overshadows all of those earnings. So clearly, India's rising forex reserves are not coming from the current account. The real growth in reserves come from what is called the capital account balance. Now, this capital account balance includes investment and loans, particularly from foreign direct investments and foreign portfolio investments or FPIs. And these have played a very crucial role in building up our foreign reserves over the last few years. In fact, if we look at the latest data for quarter 2 of FY 2024, India had a positive capital account balance of 15 billion US dollars, while the current account was negative at 9.8 billion US dollars. Another factor that affects foreign reserves is something that is called the valuation change. Now, this does not involve actual money moving in or out of the country, but instead it is a shift in the value of reserves that we already hold due to changes in exchange rates or asset prices. For example, if the US dollar strengthens, the value of our dollar denominated assets increases and it gets reflected in our reserves. The same thing happens with gold when its price rises as well. So at this point, if we all understand how India's reserves have grown, the next bigger question is, why do we really need so much of it? See, think of Forex reserves like a financial safety asset. They help protect the country from economic instability, especially during times of global financial uncertainty. When there is sudden outflow of capital, it can cause the rupee to depreciate very sharply, which makes imports more expensive and pushes inflation up. By using forex reserves, the RBI can stabilize the rupee, manage exchange rate volatility, and ensure that the country has enough liquidity to handle external shocks. For developing countries like India, which are heavily tied into the global economy, these reserves are very, very important. They reduce financial vulnerability and give confidence to international investors that India can withstand any global turbulence. A good example of this is the global financial crisis of 2008-2009, when foreign investors pulled $24.4 billion out of India all of a sudden. The rupee was at a risk of depreciating very sharply, which could have sent the economy into a very bad state. But thanks to India's forex reserves, which at that time stood at around 132 billion US dollars, the RBI was able to step in, stabilize the currency, and prevent a very big crisis. Those reserves at that time gave India the breathing room that it needed to avoid deep economic trouble. So in all, India's large forex reserve acts as a buffer which helps keep the economy steady during turbulent times and ensures that we can weather external shocks without any major disruption. It is a sign of financial resilience, something that gives both domestic and foreign investors confidence in India's ability to handle whatever comes its way. Moving on to the final section of the day, which is the small news tidbits. First, the UAE is set to increase its investment in India to 100 billion US dollars, which is surpassing the previous commitment of 75 billion US dollars made in 2018. Mr. Piyush Goyal announced this boost, which is expected to benefit key sectors such as infrastructure and technology. Second, Hitachi Energy plans to invest 2,000 crore rupees in India over the next 5 years. This investment will focus on greener power transmission and smart mobility solutions, supporting India's sustainability goals and the development of EV infrastructure. Third, Hero Motors has withdrawn its 900 crore rupee IPO, which was initially planned to reduce debt and expand its facilities. The company did not disclose the reasons for its withdrawal despite having received SEBI approval. Fourth, SEBI has approved the IPO of NSDL, which is the National Securities Depository Limited, allowing major banks to reduce their stake in India's largest depository and increasing liquidity for financial institutions. That's all the news and stories I have for you today. I hope you found this episode valuable. This is the Daily Brief Show by Zerodha. I'm your host Anurag Bansal, signing off. See you tomorrow. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.